Welcome back to Radically Rational Radio. In this episode, we are going to cover Biden signing his First Amendment and why this is a big deal and not in a good way. First, for some reference, vetoes throughout history have been a president's way of forcing Congress to have a two-thirds majority vote to put something through. One of the best ways to tell if the president and Congress and the Senate were all in alignment was a very low veto amount. And you can see right after Reagan, from Bush to Clinton, they reduced, and then in the last three presidencies, they didn't have more than 10. And Joe Biden only has 1. This is obviously a big deal. What is his veto about? Well, he lets us know. So let's jump into the video right now.
I just signed this veto because the legislation passed.
To see where this veto all starts, we need to roll back all the way back to 2015. More and more companies started putting climate change as a cost of doing business. In between 2015 to 2019, more and more companies were using climate change as a cost of doing their business and showed that being carbon neutral was equal to a net positive investment. After 4 or 5 years of retirement funds investing in many different climate and social initiative companies that were not profitable and not providing consistent returns for retirement accounts, the Department of Labor in 2020 clarified a rule which required that fiduciaries make investment decisions solely in the interest of plan participants' financial interest without regard to any financial factors such as ESG considerations. They mentioned this specifically because that's how they were muddying up the investment. They were trying to claim long-term environmental change was a positive investment factor and not the actual value of the investment. The rule also required fiduciaries to document their investment decisions and consider the cost of ESG investment options. They weren't considering the opportunity cost at all. If it was ESG related, it was always a benefit, even if financially it would have been a detriment. So in 2020, they enforced a lot of these large funds to solely base investments on financial interest, as it should be. The secondary part, this gets more into the weeds, just realize that when we all invest in a large fund, they're buying a lot of shares, so they end up having our voting rights, and they're called proxy voting rights. In 2020, they also required proxy voting to disclose conflicts of interest and allow companies to review and respond to their voting recommendations before they are issued. This rule was seen as potentially limiting the ability of ESG-minded investors, any agenda-based investors. When we're talking about someone's retirement, it needs to be cold, hard, factual returns. I think it's always important to allow the critics their say, and at the time, critics of the rule argued that they unnecessarily restrained plan fiduciaries' ability to weigh ESG factors when choosing investments and could discourage the inclusion of ESG investments in retirement plans. The current administration has indicated that it intended to review these rules. What do you mean unnecessary restraints? If you are a retirement investor, you can spend all day and all night finding every company that supports your causes. They just need to be profitable. And you can't use creative accounting with ESG factors to make it seem like a more sound investment. So this happens in 2020. Well, you probably didn't hear. At the end of November 2022, the U.S. Department of Labor announces final rule to remove barriers to considering environmental, social governance factors in plan. I don't understand what it means by removing barriers. They were saying you need to focus on only these things, not that you can't focus on those as well, but these will be the deciding factors. The U.S. Department of Labor today announced the final rule that allows plan fiduciaries to consider climate change and other environmental, social, and governance factors when select retirement investments and exercise shareholder rights, such as proxy voting. Again, this allows someone to push their agenda with your money and not your acknowledgement. It doesn't matter if you agree with it or not. There needs to be some level of consent or at least knowledge and disclosure. After extensive consulting and feedback from a wide range of stakeholders, always look for the word stakeholders. They're not shareholders. They are, I like to think of stakeholders as people trying to turn us to pawns and move us on the board. The department concluded that the two rules issued in 2020 during the prior administration unnecessarily restrained fiduciaries' ability to weigh environmental. Again, doesn't unnecessarily. They can do whatever they would like with their free time, and they can weigh those factors however they want. However, when you are talking to someone who has chosen to stay ignorant on financial dealing, you cannot legally write a bunch of soft reasons to make it look like a good investment. It's a form of fraud. Our current Secretary of Labor Marty Walsh, removing the prior administration's restrictions on planned fiduciaries will help America's workers and families as they save for a secure retirement. In what way does allowing retirement plan investors in investments that have a lower return for soft science reasons? By definition, this makes them less secure. It is an investment, a financial vehicle. It will only be measured by its financial ability. Almost immediately after Biden had gotten in 2021, he directed the federal government to identify and assess policies to protect life savings and pensions of American workers and families from the threats of climate-related financial risk. Again, you can't know what climate-related financial risk is. That is a bunch of weather games in science. You're just guessing, and it's not educated. The rule announced today will make workers' retirements and saving pensions more resilient by removing the needless barriers and ending the chilling effect created by the prior administration on considering environmental, social, and governing factors. Just so you know, over the past 5 years, ESG-related ETFs market caps have only increased. Now, if you look into those companies, none of them are turning a profit, but we are pouring hundreds of millions of dollars in the private sector through these ETFs. This is just outright propaganda. Most of this report is propaganda. Listen to this. Climate change and other environmental, social, and governance factors can be helpful. Do you see this? They're always like, well, it could be helpful, and the harms are definitely true, so we'll just say if it will help you, we'll make it a benefit. Plus, if you don't use anything carbon related, you can also call that a benefit. None of these can be accounted in any real hard costs. It is creative accounting. And this change in the ruling opened up Americans' retirement funds to being decimated. And thankfully, the midterms had happened and we had enough of a swing in Congress to actually change this. So now we get to today. The congressional disapproval of the rule submitted by the Department of Labor to prudence and loyalty in selecting investments and exchange shareholder rights. Our government agreed that these should be true. Our president changed it back as quickly as he could. And when our Congress does what they should do and gets a 216 to 204 majority to remove that, so that American retirements are actually safe because their sole measurement is a financial responsibility, our great president does his first veto and says, no, I will sacrifice your futures for an agenda. And the simple fact is, whether you think climate change is a good thing or a bad thing, as our life expectancy gets longer and costs of living get higher, one's retirement investments should be exclusively measured fiscally, period. Unfortunately, our government wants to take your money and blow it on costs. And in case you're wondering, most ESG-focused stock exchanges underperformed in 2022. ESG-labeled exchange-traded funds dropped about $2.9 billion in 2022 and $36 billion in 2021. Yeah, we were unnecessarily holding back. We were putting handcuffs on our fiduciaries, not allowing them to invest in climate-related investments. I hope you learned something. I'm Tristan. This has been Radically Rational Radio. I hope I've earned a subscribe. Thumbs up. Comment if you think this timeline is off or if I've got a bias. Thank you very much. See you next episode.